Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Simon Mott, Chief Marketing Officer for TrackInsight. TrackInsight provides curated daily data and analytics for over 7,000 ETFs listed worldwide, along with ETF market intelligence, research, and institutional consulting services. TrackInsight's data is available in North America exclusively via Nasdaq. Simon, it's great to see you again. Welcome back to Trade Talks.
Jill, thanks for having me back. Good to see you.
Good to see you as well. And let's talk about this infrastructure bill. President Biden has just proposed a huge spending bill. How are investors reacting to it?
Yeah, a lot of money potentially coming from central US government into a lot of different infrastructure projects. Very interesting that we're not seeing the ETF markets react to this bill in the same way they reacted to some of the other legislative changes proposed by the Biden administration. In total this year, we've seen about $250 billion of flows go into ETFs listed in North America. But for infrastructure, they've only picked up a very small segment of that, with about 8.6 billion of flows to date. What we have seen, though, Jill, is that speed up in the last month. Over March, about 2.4 billion of extra flows went into US infrastructure ETFs. But when you look at the size of the market overall, the bill hasn't seem to make investors particularly excited.
And post-Texas, energy infrastructure in particular is a big focus. What are the ETF markets telling us about that sector?
Yeah, I think even this side of the Atlantic, we were watching with a lot of interest as to what was happening in Texas. Obviously, it was a strange situation that such an energy-rich state faced those problems. What we've seen very interestingly is that the US energy market in terms of ETFs has really started to kind of pick up steam, if you'll excuse the pun. Over the last month, we've seen about $1 billion of flows into energy ETFs. And that's about half of what we've seen over the entire year. So far in 2021, about $2.5 billion of flows. So we can see that that market is picking up and investors are kind of allocating more to the sector. Now, what I think is interesting here, Jill, is the change in the way that investors are allocating to the energy markets. So far this year, some of the traditional energy providers, i.e. not the green energy companies, have really delivered some impressive returns. And we're seeing some of the energy ETFs year to date up anywhere between 40 and 45%. This is quite a reversal from the 2021 story, which was very much dominated by sustainable energy, solar, and green. But unfortunately, the momentum on that seems to have stopped, if not reversed completely. Now, what you'll remember is that over 2020, some of the best performing ETFs were in that clean energy space, and some of them were delivering high triple-digit percentage returns, so really phenomenal performance. But so far this year, the green energy market has seemed to suffer, with performance dropping, in some cases in terms of double digits. So I find it very interesting that the ETF markets are showing that investors are increasingly kind of allocating money to those traditional energy sectors and are possibly slowing down the pace of investment into some of those ESG areas.
And it's April 15th, traditionally what's tax day in the US, and many Americans are filing their returns. What should they know when it comes to their ETFs?
Yeah, tax day is never a great reason to smile for most people. I think the more money we can keep in our pockets, the happier most people are. But one of the great things about ETFs is they are tax efficient. And TrackInsight does a lot of research with professional investors. And one of the things they tell us is the tax efficiency that ETFs brings is one of the main reasons why they like to use ETFs over other types of investment structures. One of the great things which American investors can take advantage of, sadly not available here in Europe, is something called tax loss harvesting. And what that allows investors to do is offset any losses that they have in their ETFs against their taxes. So this is a fantastic motivation for people to use ETFs. There's downside risk limitation there. And for the audience, for this trade talk, many of the professionals will be well aware of this feature already, but for some of the personal investors, here's a great opportunity to talk to your financial advisor, talk to your RIA, and understand how ETFs might be able to help you to become a little bit more tax efficient.
All right, Simon, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.